Greetings, savvy citizens of the World Wide Web. Welcome to another insightful video on our channel. Today, we delve into the fascinating realm of economic factors affecting stocks and cryptocurrency. But before we begin, it's important to note that we are not financial advisors. We're here to share knowledge and spark discussion, but when it comes to your money, you have to do your own research. Now let's plunge into the intriguing world of stocks and cryptocurrencies. Before we dive into economic factors, it's crucial to grasp what stocks and cryptocurrencies are all about. Let's start with stocks. Stocks are essentially a piece of a company that you can buy. When you purchase a stock, you are purchasing a small portion of ownership in that company. This ownership gives you a claim on part of the company's assets and earnings. Stocks are traditionally traded on exchanges like the New York Stock Exchange or the Nasdaq, and their prices are affected by various factors, including a company's financial health, the state of the economy, and investor sentiment. Now let's move on to cryptocurrencies. Cryptocurrencies are digital or virtual currencies that use cryptography for security. Unlike traditional currencies issued by governments, also known as fiat currencies, cryptocurrencies operate on technology called blockchain, which is a decentralized system spread across many computers that manages and records transactions. The most well-known cryptocurrency is Bitcoin, but there are thousands of others, each with their own unique features and uses. Now, you might be wondering, how do these two compare? Well, the primary similarity between stocks and cryptocurrencies is that they are both investment vehicles, which means they are ways for people to potentially grow their wealth over time. However, they differ significantly in terms of volatility, regulation, and risk and reward profile. Stocks are generally considered less volatile than cryptocurrencies. They are regulated by government bodies, and their prices are influenced largely by real-world events and corporate earnings. On the other hand, cryptocurrencies can be extremely volatile, with prices that can rise or fall dramatically in a very short time. They are less regulated, and their value is often driven by speculative investing. In terms of risk and reward, both stocks and cryptocurrencies can offer high returns. But they also come with high risks. However, because of their volatility, cryptocurrencies can sometimes offer even higher potential returns and potential losses. With this foundation knowledge, we can now explore how economic factors influence these two investment options. Stocks, as traditional investment tools, are significantly affected by various economic factors. Now let's delve into these factors. First up, we have inflation. It's like that uninvited guest at a party. Nobody likes it, but it shows up anyway. When inflation rates rise, it erodes the purchasing power of money. This can lead to decreased corporate profits, which can result in lower stock prices. On the flip side, controlled inflation can indicate a growing economy, which can boost stock prices. It's a delicate balance. Next, we have interest rates. Picture it like a seesaw. When interest rates rise, borrowing costs for companies go up, often leading to decreased corporate profits and a subsequent drop in stock prices. Conversely, when rates fall, it's cheaper for businesses to borrow, potentially leading to increased profits and higher stock prices. Now let's talk about political stability. You might think politics and stocks are worlds apart, but they're more like neighbors. Political stability can foster a positive business environment, encouraging investment and driving stock prices up. However, political uncertainty can cause investors to pull back, often resulting in lower stock prices. Last but definitely not least, we have economic growth. This is the big kahuna of economic factors. When the economy is growing, companies generally see increased profits. More profits can result in higher stock prices as investors want a piece of the action. However, when economic growth slows or contracts, corporate profits often take a hit, which can lead to lower stock prices. But remember, these factors don't live in isolation. They're like a complex dance, each influencing the other, creating a dynamic and ever-changing environment for stocks. An investor must keep track of these factors, understand their interplay, and make informed decisions accordingly. As you can see, the value of stocks is directly tied to the economy's health. So while investing in stocks can be rewarding, it requires a keen eye on the economy, a dose of patience, and a pinch of daring. Now let's turn our attention to cryptocurrencies and see how they fare against these economic variables. Unlike stocks, cryptocurrencies are a newer form of investment and behave differently under economic influences. Their value is driven by a unique blend of factors. So let's unpack a few of these. First up, demand and supply. Cryptocurrencies function on a decentralized platform. Bitcoin, for instance, has a cap of 21 million coins. This limited supply, coupled with increasing demand, drives up the price. When more people want to buy cryptocurrencies than sell them, the price goes up. And when more people want to sell, the price goes down. Next, technological advancements. Cryptocurrencies are inherently tech-based assets. Any significant strides in blockchain technology or cryptographic techniques can directly influence the value of cryptocurrencies. For instance, the advent of smart contracts and decentralized finance, or DeFi, has fueled the surge in Ethereum's value. Then we have regulatory news. Cryptocurrencies are subject to regulations, and any news or rumors about potential regulations can cause significant price swings. For example, when China announced a crackdown on cryptocurrency mining, the market saw a sharp decline. Conversely, positive regulatory news, like countries accepting Bitcoin as legal tender, can trigger price surges. Finally, market sentiment. Cryptocurrency markets are highly sensitive to public sentiment and speculative news. This is partly why social media trends can cause sudden spikes or dips. Remember when a single tweet from Elon Musk sent Dogecoin soaring? However, it's crucial to note that while these factors can influence cryptocurrency prices, they don't operate in a vacuum. They're interlinked and often influence each other. For example, a technological advancement might increase demand, or a regulatory change might dampen market sentiment. Cryptocurrencies, being relatively independent of traditional economic factors, provide an interesting alternative for investors. But remember, with their volatility comes risk. So, as always, make informed decisions and tread wisely. Now that we understand how economic factors affect both stocks and cryptocurrencies, it's time to examine them side by side. Let's dive in. Stocks represent ownership in companies. Economic factors such as interest rates, inflation, and GDP growth directly influence their value. When the economy is performing well, companies generally thrive, creating a positive ripple effect on their stocks. However, stocks are also susceptible to market volatility and economic downturns. For example, during a recession, stocks can plummet as companies struggle with reduced consumer spending and tightening credit conditions. On the other hand, cryptocurrencies exist in a digital realm, largely independent of traditional economic structures. They're influenced by factors such as technological advancements, regulatory changes, and market sentiment. Cryptocurrencies can provide a hedge against inflation and economic instability due to their decentralized nature. However, they come with their own set of risks, including high volatility, regulatory uncertainty, and potential security vulnerabilities. Now let's talk about risk and reward. Stocks have been a tried and true investment avenue for decades. They offer a balance of risk and reward with potential for both capital appreciation and dividend income. While stocks can fluctuate in value, historical trends show a steady upward trajectory over the long term. Cryptocurrencies, however, are a newer player in the investment game. They offer potentially high rewards, with some investors experiencing exponential gains in a relatively short period. But this potential for high reward comes with high risk. Cryptocurrencies are notoriously volatile, with prices that can skyrocket or plummet overnight. And although cryptocurrencies have the potential to disrupt traditional financial systems and offer exciting opportunities, they're still in their infancy, and their future is uncertain. In summary, stocks and cryptocurrencies are influenced by different economic factors and offer different risk-reward profiles. Stocks are tethered to the real economy and offer a more stable, though potentially lower return. Cryptocurrencies operate in a digital, decentralized environment and offer high potential returns, but at a greater risk. Both stocks and cryptocurrencies offer unique opportunities and challenges for investors. As with any investment, it's crucial to do your own research and understand what you're getting into. We've covered a lot of ground today, so let's quickly recap. We began our journey by understanding the basics of stocks and cryptocurrencies, two distinct asset classes that have captivated the investment world. We then delved into the economic factors that influence these assets. In the realm of stocks, we found that factors such as company performance, market sentiment, inflation, and interest rates play significant roles. For instance, when a company performs well, its stock generally rises. Conversely, factors like high inflation or interest rates can depress stock prices. As we turned our attention to cryptocurrencies, we discovered that these digital assets are influenced by a different set of economic factors. Think technological advancements, regulatory news, and market sentiment. Cryptocurrencies often thrive on technological innovation and positive sentiment, yet they can be volatile in the face of regulatory changes. In our comparative analysis, we highlighted the differences and similarities between these two investment avenues. While both are influenced by market sentiment, they react differently to other economic factors due to their unique characteristics. Remember, we're not financial advisors, so always do your own research before making any investment decisions. Use the knowledge you've gained today as a starting point and continue to learn and adapt. Thanks for watching. Be sure to like, comment, and subscribe. And hit the bell notification so you'll get updates anytime we upload a new video.